So hello, ladies and gentlemen, and welcome back here on the industry stage at Formnext 2023. I hope you enjoyed a lot the really amazing presentations of our 16 startups. Fantastic innovations, a lot more to come. But however, it's clear that these innovative ventures need more than just breakthrough ideas. They need the solid support and experience of experienced partners who can provide both capital and, of course, strategic advice to make these ideas a practical success. So in today's panel discussion on finance, funding and startup culture, we want to take a look at the current state of play, assess a little bit the mood of the market because it's difficult right now, and highlight what is important for startups at the stage we just saw. So we are privileged to be joined by a high-class panel, and I look forward to an insightful and engaging dialogue. Welcome to the stage with me, to my left, Mr. Danny Piper, Managing Partner of Newcap Partners. Danny, good to have you here. Thank you for being our guest. Then we have Dr. Florian Bergmann, Chief Technology Officer at HZG Fund Management. Florian, good to have you here. Back again. And Alexander Pass, Investment Manager at Freigas. Alex, good to have you on stage. And last but not least, Arno. Good to see you. Managing Partner Arno Held of AM Ventures Management Company. So good to have you all with us. Arno, usually once a year, blast of the past. We haven't had it this year, basically, right? But if I hear your status report once a year, I'm always super excited. I'm looking promising into our promising future. So let us know, what is the atmosphere like today?
Let me start with describing it as interesting.
Okay.
I think times have changed a little bit. As with every crisis, it can also be a very, very big opportunity for everyone. I think it's the time of focus, looking internally where we can improve. And what I really like to see in the industry is how everyone is moving together and help each other out. But yeah, I mean, obviously the world has changed in the last 24 months and particularly in the last 12 months. And everyone feels that. But still, I mean, look around. The show is extremely well attended. Everyone is, economically speaking, in a good mood. And the financial situation is a little tense. Let's put it this way.
Yeah, and we will explore a little bit more the reasons behind that. But Florian, if you take Arno's statement into account, considering the startups, what is it meaning for the startups? What are they currently facing? And how can an investor help them right now?
I mean, in general, we see that the market for Series A investments and even more Series B and C investments is challenging at the moment. So for the startups, I think it's important to show commercial traction and prove the liability of the business model earlier than in the past. From an investor's perspective, we are trying to address the situation by considering and discussing potential break-even scenarios with the startups already in a potential Series A investment round to reduce the pressure then downstream. In addition, we are also able to offer support for very cost-intensive areas like the setup of production facilities or capabilities, or also in the area of sales structures, which is typically very cost-intensive. So in these times, I think it's a good approach to look for partnerships and networks to increase your reach without increasing the cost, basically.
That's getting more and more important. And like Arno mentioned, it's at least getting into partnerships is something we are more focusing at the right time right now. Danny, you have a really good overview of the US market. And usually I can remember in the past, whenever I talked to startups, they said, we first tried to make it in the States because we get easier the money. What is the current investment climate in the US? And what does that mean for your work in developing startups?
So I would say that the first thing you have to look at is the 2021 was a peak year for investments as well as M&A exits. And those things, they're important to think about together because you kind of begin with the end in mind. And so we came off this very big high. We had the peak valuations in the market in 2021. Today, we're down, I would say, significantly in valuations, but there's a lot of transactions. So I would say, first of all, for the startups that were here, the best place to be right now in the environment is at that seed stage and that Series A stage, because you don't have the complexity of your cap table. You didn't have some of these crazy valuations. And the US, especially Silicon Valley, sometimes gets out over their skis on the excitement of an industry. Maybe we're a little too exuberant. And so what the problem area that I see in the market, particularly in the US, but I think this is true everywhere, is in the Series B and Series C rounds, where you had very high valuations in 2021, and they've done 2 or 3 rounds of capital, lots of investors. Now, if they need additional capital, when they go out to market, they're getting their valuations reset, and that's where it becomes a little bit more complicated. So there's availability of capital for some of the earlier rounds, and the biggest hurdle is getting your lead investors in. That's sort of number one right now, and getting sort of that first round. But I think there's a common saying: the best time to start companies is in hard markets, and so in hard times. And so I think that breeds a different type of entrepreneur. And so this is not to be discouraging. I think if you're starting now, you're in better shape than sometimes when the money's flowing too easily and you don't have that discipline.
Exactly. It is enforcing the discipline of the startups, for sure. Alexander, at Freigeist, you have a strong connection to technology. That's at least what I heard. And I have read an interview with you at Dealflow, a recent interview, by the way. And you said you have a strong connection to hardware. I mean, Freigeist is investing in many things. So what role does additive manufacturing play in your investments? Mm-hmm. And how do you see the current climate if you see the 3 guys that are really a little bit deeper into that industry?
Yeah. So, first of all, I think the future of manufacturing is one of the key hypotheses from our side, and I think additive manufacturing is one of the sub-focus areas there. I think more investors should look at that, because it really solves main issues like supply chain risks, like sustainability. Mm-hmm. And regarding the climate, so I just want to underline what Arno said regarding the focus. So when I look at portfolio companies from our portfolio, we see it's a lot about getting this early traction. It's a lot about maybe not developing the hardware product too far, but start partnerships, start for early traction, start developing applications for customers. And yeah, I think that can be quite challenging at a seed stage.
Thank you, Alex. Arno, I mean, you're exploring the market all the time, looking for new startups to rise. Did they understood already the change in the climate in their kind of approaching you probably as a VC? And do they know what the new challenges are? Is that already in the realization phase of the startups? Or is it still like, we have a good idea, we want to start and let's see what happens?
Well, I hope that we always find these people who have a great idea and just want to start no matter what the economic situation is out there, because I fully agree with Danny. There's no better point in time to start than during a crisis, because you develop a different perspective on how to build a company. I think the general mood has arrived also with the young entrepreneurs now in the meantime. I think we had some pretty intense discussions in new investments earlier in the year, in the first 2 quarters maybe, where also especially those who funded their company, seed funded or A funded the company at the peak of valuations in 2021, now had to accept that the times have changed, and despite the entrepreneurs performing on track, developing their company as planned on growth, the multiples have dropped. So at best that they get money now is on a flat round compared to when they raised money earlier, which is extremely painful to realize. And so the discussions were quite intense. I think now, meanwhile, everyone has understood that the world that we live in now is a completely different one than 2 years ago. And I really see that everyone is doing a great effort to focus on what matters, is funding a company and developing technology and having break even in sight very closely, which is also a change that we've seen in the last 2 years. But yes, I think the discussions are much more constructive now.
Florian, the understanding's there, that's what we heard. So you have already some startups in your portfolio, right? Mm-hmm. So is it right now more about saving them and taking care that they survive, or what is the ratio between looking for new ones and taking care of the existing ones in the portfolio?
I mean, I think we have a good track record and did 7 investments over the last 2 years. Yeah, so we are pretty happy with that. Honestly, also a little bit faster than we expected at the beginning. Still, there's room and appetite to do more investments. So currently, we are in negotiation with 2-3 candidates, also to send a positive signal to the market. Of course, looking at the overall situation, we are also trying to put some money aside, to do bridge financing, for example, for the existing companies. This is not something that has come up recently. It's a little bit the strategy also of the fund, as I mentioned earlier, to at least look for, try to achieve a break-even scenario based on the serious investment round. Of course, then things often come a little bit different as planned, but it helps you to keep some discipline already from the beginning and try to be cost efficient there. So it's both. We still do investments and looking for new companies, but of course we are also supporting the existing portfolio over the next 2 to 3 years. I think until we see a turnaround in the market for Series B and C investments especially.
We are talking about that time scale later on, for sure. Alex, I mean, you are focusing on different technologies, not only additive manufacturing. Is there a shift in the focus in technologies due to the current climate, or is it something that tackles all of them right now?
I mean, I think so. We see that it gets harder to get funding for hardware startups, and it was always hard, I think, on one hand, but we still try to stick to that. On the other hand, we see trends like sustainability, where we see new climate tech funds coming up, new capital that flows in that direction. So we see an opportunity to get funding there, follow-up funding, which is crucial also for us as a seed investor. So still focusing on hardware, focusing on those technologies, deep tech, so not really changing the focus at the moment.
Danny, I mean, we heard at the presentation that what I really liked and found interesting was Coprint that raised a Kickstarter campaign. So are there then in the future probably different types of getting capital more than today? Because sometimes I have the impression we are very much focused on like exists, for example, where you get money, or then the VCs. Are there getting more, let's say, are there more ideas to get capital in the future? Do the models change right now?
I don't know if they change, but I do think that there was a shift with crowdfunding sort of coming into being in a little bit more scalable way about 10 years ago. But as it really taken root and gotten traction, entrepreneurs still have to go chase out every one of these individual investors, and it's hard to scale those. There are examples, though, that have been done where they use those as a good starting point. But at the end of the day, at some point, when you're thinking about starting your company, you should be thinking about how to set up a funding strategy. And your first round of capital could be friends and family, the seed round, it could be angel investors, it can be the Kickstarters of the world to the extent. Kickstarter becomes a better platform when you're an application company. It doesn't work well for a material company. Like when I think about the spectrum of companies that hit additive, the most capital intensive and the longest time frame to get to market to where you're actually getting to the point of where I'll saying, get to break even as fast as you can. That's the hardest one to get to. Hardware kind of comes in second, and in terms of that process, at least from what I can see, application companies are trying to typically leverage existing technologies with an application. They're the fastest to market. They're usually the most suitable for those kind of Kickstarters to start things off, prove out. They call it your MVP, your minimal viable product. Those are the things that I think those types of things will appeal to, especially if you're in that B2C world where you can now have something that's interesting and people want to join a campaign and get behind it. That doesn't work as well when you're making something that's industrial or so it's not as applicable. So I don't think the revenue models are not the funding models have changed much. But I do think for certain applications, there are some, I think, visible ways that you're seeing that early stage of capital. But then it starts to shift as you start managing the next funding rounds. It's too hard to use a bunch of individual investors to do that with. So you go back to traditional VCs, institutional investors, CVCs, really still fill that gap.
Before we get to some criteria, which I would be interested in, how you select now startups and how that changed, Florian, let me ask you another question. So if I see some of the startups, they solve a challenge that a client has. Let's say in a production area, you have an innovative method to create grippers for robots, whatever, okay? So wouldn't it be ideal to catch up with a potential client and get him as an investor? Is that the model that exists? Or that's something you encourage?
I think it's a valid model that exists in general, and I think corporate VCs to a certain extent follow that approach. The problem is when you're a young company, often you don't know what are your biggest bets here. Often things develop during the time, and when you're kind of locked into an investor at a pretty early stage, this can be riskier. Of course, it reduces risk initially, but you may not get the full benefit at the end, I think.
Okay, and you never know where your way goes. So
yes, I mean, that is also the background why we didn't pull in corporate investors in our family-oriented fund, because it provides the most flexibility for the companies at that stage, of course.
Very good. Let's talk a little bit about criteria, Arno, if I'm allowed to ask. So has the criteria for selection of a startup or to evaluate a startup, has that changed, like in the ratio of focus points? We want to talk about startup culture as well. Do they need to change their culture as one criteria in order to be more attractive for a VC right now?
Not necessarily. I think there was always a set of criterion that experienced investor applies to select a good company. Of course, for us, over time, AM Ventures was founded 9 years ago, a little bit over 9 years ago. This set of criterion was adapted, and you use a lot of your experience to build your new benchmark. But in the end, still, HZG, AM Ventures, as early stage investors, our main task is to find out whether a team of engineers is going to be good entrepreneurs before they know it themselves. This is probably the main challenge in the first couple of weeks of discussions. And of course, you look into a business plan that the team provides, not necessarily because you believe in the business plan, but to find out how this team structures themselves and how they view a market. And everything will be adapted after the investment. The business plan is obsolete 2 weeks after you signed the contract.
Yeah.
But it helps you to understand how a team thinks. And I don't think that this has changed over time. Early stage investing is a people business, right? And you have to get to know the people and build trust.
Nevertheless, Danny, we were talking about getting to break even as fast as possible. And the startups I know in additive manufacturing, so the time frame to get to that point is not that fast like in other industries. So if you want to do more pressure, how can you help then the startup to get to that point quicker?
Well, it depends on the problem that they're going to solve, right? I mean, I think we just kind of said application companies have it the easiest. I think getting to cash flow break even on a hardware company, or even harder, the material companies, you first have to understand in that first round, I first of all agree 100% with what Arno said. I think when you look at that first stage of investment, we always say in real estate, you say location, location, location. And in early stage investing, you say management, management, management. And what you're really looking for is a team that has the technical competence, but has sort of the nimbleness to be agile, to move, to adjust quickly, and use the capital wisely, because I think that's that's what's hard. And I think that's sometimes the value your investors can bring is help bringing advice to how you use capital, not necessarily how you manage the technology. That's what we expect them to bring. Where I think from the standpoint though, getting to break even, it's fundamentally, when you think about your funding strategy, you've got to solve technology risk up front, right? You've got to minimize that technology risk. And then you have financing risk that comes later. So it's hard to put an expectation on somebody to say, hey, I'm going to give you a seed round, expect you to be break even in the next year. I think most everybody realizes that. But what everybody wants to understand is, where do you see these breakpoints? Have you really thought through what your capital needs are really going to be? And I think that's the biggest shortfall a lot of people will miss, is understanding where they think the real amount of money is that they're going to need, and then how to execute on that plan. And I think that's a lot of the miscommunication work. And I think that's some of the things that I'm sure the stories that we can tell you are mismanaged expectations that the management team had on what they really needed to get there. And so I think for the entrepreneurs that are out there, look at the case studies that have come before you in the markets that you're in and use that as a guide and an example. But yes, when you get to that past your Series A round, you got to start thinking about what's left in terms of market risk and getting to that cash flow break even by a Series B round, and especially in this environment.
But yeah, Alex?
Maybe one comment on that. So from a perspective of a seed investor, always the big goal is to find the product market fit in that time frame. And as this shortens, the amount of capital is less, and you have less time to achieve that. When I talk to technical teams, it gets much more important from my perspective to see this super deep understanding of the customer, and to really to grasp this kind of idea of the product market fit even earlier. So in very early stages, who really is the customer? What's the value proposition? And especially from university spin-offs, very technical teams, this is something that lacks at some teams, I think.
Is that something where you help the startups with? Because I imagine today we heard one startup that was ODAP that mentioned the voice of the customer, which I really like. I mean, it was kind of the end user of the product was not really the one that is investing. But I mean, from my economic perspective, the most important thing at the very beginning is to listen to the voice of the customer in order to evaluate, is that something that is worth the customer paying money for that or using it? How do we help the startups? Or is that really something, sorry for that, I'm very pessimistic on that one. If you have a great idea, is that something they're really considering? Most of them? Danny? Be honest.
It's nice when they have that visibility to the customer. And it's nice when they can do that. I don't think that's always the case, especially as you get to hardware tech. You may not always get that visibility to the customer. The simplest example I'll use, I'm wearing a pair of 3D printed shoes today. And the founder of this company, we put in front of a company that's doing small run production of shoes already. So what does he really need? What are the price points? We're able to bring a few companies in to set expectations before you go out and do your first raise, starting to understand those pieces. When you can do that, it's great. The hard part is when you got a technology that's so deep that you're developing a technology where you don't understand where the customer is. And that's like, this is super simple. The stuff you're doing in deep tech, super hard. So you really are going to go on a leap of faith of understanding what that pathway is going to be. And you know that you don't have it right. As Arno said, the plan's outdated. It's the process of planning that becomes important and the nimbleness of that team.
But do they have this people in place? Because I can't imagine that most of the time the founder is like, wow, I have this great idea. And I met so many of them. And then, I mean, I'm an external. I have no idea of editing in the meantime a little bit. But basically I ask the question, who's going to be your customer? And what is the application I'm looking forward to? And then it's getting difficult, you know? And then it could be this and it could be this. But I imagine I'm being an investor, but I don't have the money. But I imagine I'm be one. I would never give them money because if I don't get this question answered the proper way, it's not worth the money to spend to. But on the other side, I would never expect from a technical founder to think about that. Alex, what do you think?
So thinking about what? Sorry.
About the customer proposition or the value proposition and let's say, condense it to a point where you say, okay, this is where I'm going to do my money with.
Yeah, I think that's true. Coming from the technology, it's quite hard. But you can start by deeply understanding the value proposition, maybe on the technical level, and deeply understanding, okay, so what are the dimensions that I'm comparing on the hardware level, for example, to competitors, and then you can you have a starting point of how to cluster customers, how to approach this go-to-market process, how to find the product market fit. But at least on that level, I think we expect even technical founders to approach the challenge. Yeah.
Can I add something to that? I think sometimes you don't get the opportunity to have the customer, but what I find important when I'm looking at these early stage companies is their understanding of the competitive landscape. Where do they fit into this ecosystem? What are they doing differently that there isn't a defined spot in the market for yet that they're going to fill a void? We don't, and you have market risk that you can't always solve for because you're still trying to solve for this technical risk. And can you do something that nobody else has done before? So you first have to prove that that is a potential viable technology in its own right. And you're making a bet to some extent that the competitive landscape's open enough that you've got enough runway to start to get the time to do the traction. And that's sometimes at your Series B round or your later Series A round, depending on how expensive or what kind of tech you're doing.
An approach we often use to get a better understanding of the applications is, as Arno mentions, to work through the business plan and challenge the team. Okay, what is the rationale behind the individual revenue streams, yeah? And thereby you learn pretty fast how well thought and structured the approach of the team is. I think to your point, of course, it differs very much on the maturity of the technology. Yeah? So when you are a player in an existing market, it's more easy to validate that, even with voice of customer. If you are in a more advanced technology, which is maybe 5 to 10 years out for full commercialization, that is a little bit than the estimation of the team. But we also challenge ourselves within the team. Yeah? How big is the probability for the individual applications? And also what is the creativity and the opportunity to build new applications, yeah, out of one that is close?
Anna, you want to add something?
So when we are approached by early stage founders who have just founded a company and are looking to raise their first round of money, we observe two different kinds of entrepreneurs. One is a group of industry veterans, experienced guys who have worked in corporate maybe or smaller sized companies, and through their career over decades they have realized a big problem and they are developing a solution for a very concrete problem. The other category is mostly younger engineers fresh from university or from research who have developed a fantastic solution to a problem that they don't know yet, or let's say have developed a fantastic technology and they don't know the application for it yet. And this is an extremely challenging case which needs extremely experienced industry-specific investors, because only guys with decades of experience in a very certain vertical like additive manufacturing can evaluate the business potential of this technology that the founders have invented, but they don't even know where it's being applied. And especially in the very early phases, our mission here is to focus these founders in the right direction. Say, you don't have to address every single vertical out there. It's not 5 different verticals with a team of 3 people that you are addressing. Find the 2 projects that are bringing you through the next 2 years, and then let's see how we grow out of this. And that is oftentimes an interesting challenge. It's a very intense evaluation, and you have to apply your decades of experience. And the discussions are interesting as well, because it also needs some, let's say, convincing, because engineers can be very convinced of their technology.
I know that. And that brings me to my next point now that we discussed several times. How much are you allowed, or what is your opinion on how much can you influence the startup as an investor? Because on the one hand, of course, you want to have a success. You want to give a bet on something that is successful later on, so that you can have your exit or whatever is the target. Yeah. On the other hand, you don't want to influence too much. So how is your support model? Because it might come to a point where you're a little bit influencing and not only supporting anymore. Alex?
Yeah, I mean, we have this discussion internally a lot, as we are very operational VC, and I think it's always extremely important to understand that you're not at the steering wheel, but you are more as a coach. You would act as someone asking the right questions. And I think this is crucial, because in the end, the founder really knows the product, really knows the market, and not you as the investor. But you can ask the right questions, you can guide, you can apply frameworks that you might learn from other portfolio companies. But it's on that as well, it's super hard to see patterns in the portfolio and bring them to new ventures, because every company is super different. So very, I would say, very finicky, very detailed to decide how to coach.
Yeah. Because I remember in our pre-discussion, we tackled a little bit the topic of sales. And so I'm from sales. So I imagine being this young entrepreneur and have great ideas. And probably I'm very good in selling it because I'm so much convinced of it. But on the other side, I'm not probably realistic on the whole thing. And now you as an experienced person, Danny, come over and you give the money to the investment and say, okay, but now listen to my consultation. And as I know, not only from Arno, but from my own experience, sometimes they don't even listen to you because they're so convinced of themselves and their idea. How do you handle that?
That's great. I mean, I look at it as sort of the two C's. They better have conviction and coachability, right? They need to have that conviction in what they're doing and a belief in it, because we don't have all the answers. I mean, let's not kid ourselves. We are helpful in the process. We've seen things. We've seen how things don't work. You have to have that conviction to stay with a path, but you've got to be coachable. And I think when you have entrepreneurs that aren't curious, they don't look at all the different angles, they get too narrow focused, that's a problem area. If they aren't listening to others, and that's, by the way, if they're doing it to the investor, they're doing it to their teams below them. And how do they grow that organization? And that's a giant red flag. So the coachability is extremely important. They don't have to always take recommendations because, again, we're not always right, but they need to be able to process and communicate for why and what they're going to do and what their plan is, and make sure they're evaluating the inputs of investors, potential customers, employees, management teams that they bring on. So coachability is huge. And I that's why we say management early on is how coachable are they? Because if they're not, I think there's a point where it's too rigid and it's their way or the highway, and that's going to be for everybody in the organization. So they become too challenging to work with.
As they are the top, Arno?
Yeah, I mean, just adding to this, that also for the young founders out there, this is why an investment process is so extremely intense. Because I don't want to find out that the relationship doesn't work once the ink is dry and the investment papers are signed. We are all undergoing a very intense negotiation in a term sheet. We are doing financial, legal, technical, team due diligence. We are negotiating shareholder agreements and investment agreements to get to know each other. How do we handle conflict? How do we resolve different views? How do we deal with each other? How do we communicate very, very critical issues? And it should not happen too often, but we had situations where we pulled the plug in an investment discussion extremely late in the process because we realized that we cannot fight with the founders. But in the end, developing a company and a whole organization into the future is a lot of constructive fighting. It's a lot of discussions in the board with founders and with shareholders to move that vehicle in the right direction and shaping an organization with the help of a large variety of different opinions. So it's extremely important. And this is why the investment process is so intense. This is why you have a lot of tough negotiations on the table, because that helps you to get to know each other and develop a culture of fighting and discussing.
And it's a learning curve, basically. You are pushing at the startup. Alex mentions the difference between the companies, Florian. If you consider your portfolio, what is the main challenge, regardless of the investment? Okay, we do have our investment from your side. So if you see them developing, what is the main area of challenge they have? Is it like going on with their product, finding the right partners, or the sales, pricing, marketing? What is the main challenge you see?
I think if you look across the portfolio, really sales is the main challenge in the phase we are investing. Often the founders have a technical background. Sometimes they have some track already in the industry, sometimes not. But really to go out, sell a product, convinced, but also meet the expectation of the customer. I think that is the trick, and the people there, or the point where a lot of companies are struggling at the moment or challenged, especially in the times like these, where I would say the overall economic situation is a little bit mixed, I would say. So there are markets which are still very positive, and there are others which are challenging at the moment. So you need a lot of experience and tools, which you typically develop as a salespeople over years or decades to really find the right doors where you knock the door and have a high probability for a successful business at the end. And this is not something you can kind of learn or buy or get at the university. So you better look for experienced salespeople that help you on the journey. And in some cases, we could help them. We also added a small team that acts in a kind of reseller mode to support the companies if they want it. And yeah, to Arno's point, also the industry experience, I think, is a big variable. People who are from the industry, they understand the importance and relevance of sales, and therefore consider that in the early stage, already get connected with people from their background, whereas new founders typically struggle more in that area.
But Alex, I need to...
maybe one comment on that. So what I also see is the challenge of scaling up a team. So after the seed investment or even Series A investment, I think it's much bigger. Then scaling up from, let's say, 20 to 40, 50 people puts huge stress on the company and also questions the founders. Are you really the CTO guy, or are you more on the product development or on that side? And this puts so much stress on it. And I think a lot of companies underestimate that kind of stress and shoot for the stars. We want to scale up to 50 people, but maybe that's not the right time for that, and maybe you need to do that a little more slowly, understand how to keep the culture that you're currently setting, how to scale up in a sustainable way.
But Danny, that's really a question. I remember our discussion, and really, I consider exactly that situation that Alex described. I'm at 20 people, and I know that I really quickly need to hire another 20, 25. So, and you are fully engaged already with your development of the product, with probably talking to potential partners, or as Arno described, with the investment round, where you have to put all your effort in. And so you have to decide on that people, and you don't have the time to select each and every one of them. But let's face it. The first doubling the employees is the most crucial one, because then you have the ones that determine your future path. So how much influence you put in that, or how much help can you give the startups here?
That first group, it sounds like it's the most important group. I'll tell you, it's probably not. And this becomes the harder part, because Alex is 100% right. The hardest part I think founders have is that scale, because it puts them in positions that are usually in this industry. You have technical founders, and now they have to become managers, and that's a hard thing to do. And most likely, there's what's the saying? You hire slow and fire quickly. It's a saying. So hard to do, right? It's not. It's easier said than done. And I think where learning how to become a manager, understand who the right people are, because you're not going to get it right out of the gate. And it's going to be a continual process all the way through. And actually, it not only is it that first group, but when you see a manager go from 20 people in a company to 80, it becomes overwhelming, the administrative processes. So you do have to get the right people in the right positions, and you're not going to get it right away as a founder. Nobody expects you're going to always get it right. Everybody's having to shift through. And what you'll often find, sometimes you're going to find your superstars, and you got to figure a way to work with them, and then you've got to figure out a way to augment those teams. Managing is very tough, and sometimes, I think Alex said it, is sometimes that means the founder isn't the CEO anymore, and it's a hard one for them sometimes to think about. But when they get to that realization, they become really a CTO, and that's okay too. So it just depends on where their skill sets are, and you'll see founders get burned out and overwhelmed, and it's a lot of times because they're really doing positions that aren't their highest and best use of what they're capable of.
But let me sum up quickly that discussion about resources, because there's really a burning question inside me that I want to get to you, all of you. So if we're talking about the right persons at the right timing, by the way, it's not only about the right person, you need the right timing to hire them. You as investors, I know Arno's team a little bit. Fry guys, you are roughly like 20 people, or how many are you?
Yeah, 20.
So Florian, I know your team a little bit. Danny, I don't know your team. But where do you get the expertise from, don't get me wrong, in order to evaluate, are that the right managers, or is that the right sales guy? Is it based on experience from other investments? Because not all of you have been sales before, or managers before. Don't get me wrong. How do you decide, or how do you consult on that?
Well, look, I'm happy to take a first crack at that. I don't think it's our position to go hire these people or provide the evaluation. I think it's there to provide advice and a sounding board of how do they restructure, what do they do when they have the problem candidates, and when is the right time to bring people on for certain roles. Those things we can be advisors to, but the actual process of selecting and finding the right candidates, by the way, that's one of the excellent things in a down market. You get some really good talent that comes in the market. This is a great time to be looking for talent because they become a little bit more available than in those tight times where money's just flowing out everywhere. That means there's opportunities everywhere. But I don't think that's the investor's role to sometimes be picking those, just really helping advise the CEO and the management teams on the timing and use of capital. As you started on this one earlier, Sven, I think it was sort of a question of like, as a salesperson, right? Sales is always the most important thing if you're a salesperson. And it's very important in these processes, but I do see that as one of the footfalls a lot of companies make is they get too aggressive on the sales side before they've managed their technology risk, before they've gotten that MVP down, and they start burning money on sales teams and organizations, and they start that burn rate, which makes them require more capital. So those are the things that I think we can be helpful to the companies on thinking, but when it comes down to the individual contributors, it's down to the company and the CEO.
Florian, what is your opinion on that?
I mean, this is a very complex question. I think we approach it from two directions. One is to train and work with the existing team. In our team, we have, I think, a good background how to build and grow a company, learn a lot of positive and negative things along the way. So that is something we can share. To Alex's point, it's always it's a questioning and challenging process, an iterative process. Yeah, it's not that we say do this or that. We ask questions, we try to help the team, to find the questions on themselves. And often they have it already kind of already in their minds, but they don't really get it on the table, become clear about it. So that is where we can help them through workshops, for example, we do with the teams. And second, it's of course adding the right people and expertise at the right point in time. And what we do there, we use a lot of our network, honestly. We use shows like here at Formnext. And I think the beauty about the additive industry is typically once people are in the industry, they somehow stick to it. They got engaged, and so your network grows year by year. So I would say most of the kind of managers or key persons we bring into our portfolio companies are somehow connected to our network.
Absolutely.
Yeah. Just want to put emphasis on that point. So what works really well for us is putting together our portfolio companies, but not on only on the strategic CEO level, but also on the operator level. So if there's someone who built a CRM for one portfolio company, he can help on the other, and maybe there's a synergy between different companies. So really connecting the operator level of portfolio companies, this really works well for us.
That's basically something you do as well, right, Arno? I mean, you connected.
Absolutely. I mean, experience beats everything. I love the saying, good judgment comes from experience, experience comes from bad judgment. And it really helps to talk to those people who have made bad judgment in the past, including us, right? It took us 9 years to get to where we are right now. So of course, in the beginning, we also made some decisions that we would not take today anymore. But we consist of a bunch of people with decades of industry experience, and we've led hundreds of people at some point in our lives. So sharing this experience and applying this experience always helps. And exactly, bringing the portfolio together. HZG does it once a year, at least. We do it at least once a year, that our portfolio founders gather at a certain location with all of our investors together for a couple of days of networking and exchanging on experience. Because now we have a portfolio of 18 companies from 3 different continents, 6 countries. And I'm convinced that every founder has made every mistake at some point in time already, and they have found their way to solve it. And if you use the intelligence of this crowd to help mistakes in the to avoid mistakes in the future, that's experience. That's the power of the crowd.
So my wish for the end of this panel discussion, as I have 20,000 more questions in my head that I would like to ask you, is let's finish with a positive outlook in terms of what's your tip for this not even hard times, for these different times for the startups. Your each and every individual tip for the startups, probably the ones that we've seen today. Yeah, just give a quick tip and let's see how they can use it afterwards. Who wants to start? I should never ask.
Maybe I'm going to start.
Sorry.
Go ahead. I would start with partnership, yeah. Partnership on the investor side, but also on the customer side. So really, in the early phase, try to find the right customers for you, and because these customers help you to really understand the needs of the market, and they can be a very good factor to validate your business model, and their reputation helps them then to really conquer the market. So find the right customers in the early years. That has, I think, always been a great success factor for building up a company.
Awesome.
Mm-hmm. I think I already said it, but start the go-to-market product market fit journey as soon as possible. So during the development of technology, already start to call some potential customers. Just get this matrix of dimensions and really understand what are we building here? What is the real customer for it? Start it as early as possible. So I think that's my advice.
I would say for me, in these times right now, for all the founders, resilience is king. If you're going through hell, keep going, don't stop. It's really important to focus on the end goal and work your way through it, because it's extremely difficult right now. And I can speak from experience. When I built the fund that we're on right now, I had 200 unsuccessful pitches until the first LPs converted into tickets. And if you focus on defeat and on the setbacks, you will be discouraged so extremely quickly. So you have to have the why in mind. Why are you doing this? For whom are you doing this? What is that? You have to visualize your goal and keep going for it, because in these times, weak companies are destroyed by crisis. Good companies survive the crisis, and the greatest companies are being enforced and get better through a crisis. And you will get through this. We are in a cycle. Now we're down here. Maybe the bottom part is already in the rearview mirror. We don't know, but we know it will go upwards again. So survive, focus on your goal, and keep going. Don't stop.
Yeah.
Thank you. Closing advice.
No, I 100% agree. I think on the idea, this is, again, starting companies in the down market, it's a good time. Bring that discipline. Don't forget where you started, because I think sometimes that's one of the things you'll lose sight of later. It's always a constant evolution of growing and being curious and evolving, because if you lose that, right, and this is a lot of companies will blow up because you've got founders that have egos because they overcame a first obstacle. You're going to have lots of obstacles, and that's part of the process. That's why you're an entrepreneur, and I think this is where innovation comes from. This is why I think I like to think that venture capitalists are glass half full people. And later in life, you're going to meet groups like private equity, and they're glass half empty people. How do we optimize this for the finest dollar and to the penny to whatever it is? It's a different breed. But enjoy this phase, because there's a creative process that you're going through, and forget what's going on in the external environment. Internalize why you're doing it, exactly as they said. Make sure you have the right product market fit we've talked about. And really understand, make sure you know your market and your competitive landscape. Just because there's a lot of times that there are Me Too companies and somebody just didn't do the homework right up front. But don't be discouraged. I do think that we've sort of hit about as bottom as you're going to get here. I don't know when we say we're going to lift off and take off, but it's inevitable. You can see it in this industry. 2014 was a peak in the market, came back down. 2021. Now we're back down again. We're going to come back up. It's just inevitable. The trajectory of this industry for changing the way manufacturing done, that's not going away. We're going to continue to improve, and you're at the heart of it.
What a positive end of this panel discussion. Hey, for you, thank you so much. It was more than a pleasure to have you on stage. Very optimistic outlook. I loved the discussion so much. Thank you so much. Enjoy the rest of the fair. Good luck and success with your venture capitalist investments, and hope to see you soon. Okay, ladies and gentlemen, this was the panel on finance and big applause for the guys here. Well deserved. Well deserved. Absolutely. So, ladies and gentlemen, we do a short break, and afterwards we are going to hand over the awards, and one of the panelists will do that. So stay tuned. A few minutes later, we will back here on the live stream and hand over the award. Thank you so much for watching up to now. See you soon.